All right, let's jump right in. We're talking about something that has become absolutely critical in today's finance world, the capital stack. And why now? Well, because in this market, understanding how a deal is actually built from the ground up, it's no longer just a nice to have. It is everything. It's the key that unlocks the door to funding.
Wow. I mean, that quote just hits the nail on the head, doesn't it? We're playing in a high-stakes game now, and just having a great asset isn't going to cut it anymore. It's all about the financial architecture, the integrity of the structure holding the whole thing up. Okay, so here's what we're going to cover. First, we'll look at the new funding reality out there. Then, we'll deconstruct what a capital stack actually is. We'll break down its 4 main layers, see how it works in the real world, and then we'll wrap up with the big mindset shift you need to have for 2026.
So first up, let's tackle the big problem everyone's facing right now. The lending world has fundamentally changed, and it's created this funding gap.
You know, this is the question on everyone's mind. You can have a fantastic A-plus asset, a rock-solid plan, and you still walk away from the bank with a no. So what is really going on here? And here's the thing you've got to understand. The old playbook is gone. The days of walking in and getting one single giant cheap loan, they're over. Lenders today, they're looking right past your beautiful asset and putting the financial blueprint of the deal itself under a microscope. They're looking for a structure that's built to withstand a storm.
And this chart, it shows you the problem in black and white. Your senior lenders, the big traditional banks, they've taken a step back. Just a few years ago, you could get them to fund 65% of your project's value. Today, you'd be lucky to get 55%. And that 10% difference, that is the funding gap. That's the hole everyone is scrambling to fill.
This really captures the new philosophy. It's not about building a house of cards with as much debt as you can find just to squeeze out a tiny bit more return. Nope. Today, it's all about building a resilient, stress-tested financial structure that can take a punch. Lenders want to see that you're not just prepared for the good times, but for the bad times too.
Okay, so we've got this gap. How do we build that bridge? Well, the answer lies in mastering the capital stack. You really need to start thinking of it as your project's financial blueprint.
So what is a capital stack, really? It's not just a random pile of money. It's a super strategic, carefully layered arrangement of different kinds of capital. And each layer has its own risk profile. And, this is the most important part, its own specific spot in line when it's time to get paid back. The best way to picture it is like a tower of building blocks. The foundation, the big block at the very bottom, that's the safest money in the entire deal. It gets paid back first, guaranteed. But as you go up the tower, each block gets a little smaller, a little riskier. The tiny block at the very top, it gets paid dead last. But if things go well, it also gets the biggest reward. All right, let's pull this thing apart and look at the pieces. We're going to break down the 4 distinct layers that make up this whole structure. Okay, here are the 4 main players in our stack, starting from the ground floor and working our way up. We begin with senior debt. That's our foundation. Right on top of that, you have mezzanine debt, which acts like a bridge. Then you've got preferred equity, which is a kind of flexible hybrid. And sitting right at the top, you have common equity, the part that takes on the most risk for the biggest potential upside.
And this little table right here, this is your cheat sheet. It lays out that core relationship perfectly. See how it works? Senior debt, lowest risk, gets paid first. Mezzanine debt, medium risk, gets paid second. Preferred equity, a little more risk, paid third. And finally, common equity, highest risk, paid last. This pecking order is what makes the whole thing work. It's the engine of the capital stack.
Okay, enough with the theory. Let's see how this blueprint actually solves some very real, very painful problems that people are facing in today's market, right? First up, a scenario that is hitting so many people right now. You have a great asset, but you're facing that dreaded refinancing gap. So picture this. Your loan is due, but because property values have dipped a bit and banks are nervous, the new loan at 55% isn't big enough to pay off the old one. So what do? Well, the solution is to strategically slide in a new layer, in this case, preferred equity. It plugs that hole, bridges the gap between your new loan and your equity, and boom, the deal is saved. Okay, for our next act, let's talk about building something from the ground up. This comes with its own set of funding headaches.
So the bank says, we'll give you half. But the developer is thinking, man, I don't want to put up the other half in cold hard cash. This is where mezzanine debt becomes your best friend. A mezz lender comes in and provides another, say, 15%. That takes the developer's required cash from 50% all the way down to 35%. That's huge. It juices their potential return and frees up their capital to go do another deal.
And for our last scenario, let's get a little more creative. We're talking about an opportunistic buy, acquiring an asset that's in trouble and isn't making any money right now.
The problem here is pretty simple. No income, no bank loan. The banks just won't touch it. So what do? You get creative with your stack. You use a combination of private debt, sometimes called bridge financing. It's more expensive, for sure, but it gets you control of the asset. Then, once you've worked your magic, stabilized the property, and got the income flowing, you can go back and refinance the entire stack with much cheaper traditional bank debt.
You see, these examples show that structuring your capital stack isn't just some boring financial exercise. It's a strategic weapon. So let's tie this all together with the key takeaways and the mindset shift you absolutely need for 2026.
Okay, here's your checklist. First off, don't get greedy with leverage. Resilience is the name of the game. Second, make sure your waterfall, the repayment order, is crystal clear to everyone. Third, really understand dilution. Know exactly how bringing in new partners affects your ownership. Also, make sure your financing term lines up with your actual business plan. And finally, vet your partners. You want to know that the people you're in a deal with are going to be solid when things get tough.
And this final thought, man, it just sums it all up, doesn't it? In this market, winning isn't about being the biggest daredevil. It's about being the smartest architect. The way you structure your capital is no longer a footnote, it's the headline. So I'll leave you with this. Is your financial blueprint just a sketch, or is it an intelligently designed structure built to win?